Welcome, everybody, to this live webinar. My name is Ryan Masad from TD Direct Investing. And today we're doing part 5 of 5, Creating a Trade Plan. And rejoining us for one last time is Patrick Ceresna from Big Picture Trading. Patrick, on to you.
Well, thank you very much, Ryan, and hello, everyone. And I'm looking forward to taking you through part 5, where we're going to dive into the sort of kind of putting it all together. Just very quickly, those that haven't run into me, I am a co-host of Macro Voices and the Market Huddle podcasts. They're free online. You can watch them anytime. You can follow me on Twitter at Patrick Ceresna or visit our website, Big Picture Trading. So what I wanted to focus on in part 5 is putting it all together. So in the first parts, we talked about what technical analysis is, pattern recognition, indicators, how to do all of this, and just kind of putting it all together. But the question is, how do you make decisions using this, right? And so what it requires is some degree of a plan. You have to understand yourself, what you're looking for, and how you're going to execute the strategies, how you're going to manage risk, how you're going to assess your results. And these are all elements that we need to be able to capture, and the goal of this segment here on designing a trade plan is to address those little things that actually differentiate people that are successful at this versus people that struggle or get stuck in the mud and don't seem to be getting anywhere with it. So let's kind of dive into it and talk about, I just keep repeating the same thing on technical analysis, just in an opening slide that is so important. Why use technical analysis? Now, I'll keep saying fundamental analysis is important. I would never want to diminish it. Understanding the quality of the company, management, its opportunities, all of these things are fundamentally important. But fundamentals only understand the value of the company itself. You know, its balance sheets and comparative value to other companies. But technical analysis lives in a different part of the market, which is it's the observation how investors are actually allocating money. Are people actually buying the stock you're interested in? If you think about it, if you own a fundamentally good stock, there should be very healthy accumulation. People should be buying it. If there's something fundamentally good and everyone is selling it, why? Technical analysis is a story of how the price is trending, which is a reflection of sentiment, how investors are behaving in rational or irrational moves as a herd of investors buying and selling throughout these market cycles. And certain price levels reflect psychology. This is why when certain price levels are tested, the market bounces off those levels. It's a reflexivity of how investors behave at different turns. We can gain an edge by observing the way all investors are participating in the market beyond fundamentals, and it's about merging it all together. So let's dive into this. So components of a trade plan. And the components of a trade plan, we first just have to stop and reflect, what is a trade plan? What are we trying to achieve? And it shares many of the same characteristics as a business plan. Think if you're an entrepreneur and you wanted to go to the bank and ask for a loan for your business. I mean, in the end, you just come and say, I want to open a small little restaurant, and the bank manager is going to say, well, okay, what's your plan? How much do you need? How much is it going to cost? What is it going to be to put it all together? And if you don't know any of the numbers, then what do you think the business manager or the bank manager is going to say? Say, get out of here. I'm not giving you any money, because in the end, you're not demonstrating any of the characteristics that you actually are have a good plan of how you're going to execute your business. And so it's the same thing in trading. Everybody needs to have an approach. What is my game plan? What I've known personally from having trained tens of thousands of traders, I have yet to ever meet two traders that actually think and act the same. And so therefore, this is not about some cookie cutter way of there's one right way and everyone just needs to keep changing themselves till they've hit this one right way of investing. No, what it is you have to develop something that makes sense for you, the way you want to look at the market, the way you want to approach the market. And you have to genuinely believe in the way you plan on managing your money, because you will fail at executing it unless you genuinely believe. Let's take the most basic element. Like, there are the dividend reinvestment investors. They basically say, I have a simple plan: buy the highest quality dividend paying stocks, and as the dividends are paid to me, I reinvest those dividends in a drip plan or whatever, and reinvest. This is a plan. They make keep it super simple, but they believe in it, and they believe in it that that's the way that they're approaching it, and they ride the ups and downs using the same method of managing it. So now that's a very simple example, but what you want to think is in the spirit of that, what we're seeking in a plan is to develop a methodology from which you participate in the market on an ongoing basis. So what is the misconception? You don't need a brilliant and revolutionary way of trading or investing to make a good plan. In fact, it just needs to, you need a basic, straightforward game plan that you can demonstrate discipline and consistency. Because what you will find is that, especially during periods like, for instance, when we're recording this, the markets are going through a bear market and all these crazy volatility in the markets, it is so hard to stay disciplined and consistent when everything seems to be blowing up all around you. And what you need in a good plan is the confidence to stay the course, and that is just defining that for yourself. So developing demonstrates you have an approach. It defines your rules. It helps you to ensure you understand the risks you're taking in the trading, and it gives you the ability to measure success and failure of whether or not you are actually committing and following through with what you set out to do. It's so important to develop something that you can measure yourself based upon. So what are the components? Well, we're going to break it down into investment objectives, personal assessments, understanding risk management and how you're going to approach the risk management of your investments. We're going to talk about execution strategies, and then about reviewing your results. And so let's dive into it. So components, a higher overview. So let's start with the objective. The objective is sort of like a mission statement. What is it that you are seeking to do? Now, the most obvious example is if you were, let's say, a fund manager. If, let's say, you got a job at TD with their mutual fund department as a mutual fund manager, and your mandate, you were put in charge of the Canadian Equity Fund. What you were doing is you were given a mandate to take investors' money and invest it in the highest quality Canadian equity stocks based upon the criteria that you guys set out in that fund. What happens is that the manager has only so much discretion because they've been given a mandate. They basically said, this is a Canadian equity fund. We are not going to start buying international stocks just because we think they're cheap. We have a mandate. It's a Canadian equity. So there's an example of the fact that you give yourself an objective. What is your goal? Is it to make income through your investments? Is it for longer term growth? What is the objective you're seeking? How are you? And what you want to do is have that plan. You need to have the bigger view of what it is that you're trying to achieve for your account. Now, what I do like is, and want to always point out, is it doesn't have to be a blanket investment plan for all your investments. What often happens is that someone may have a different plan for their retirement account than they have for their trading account. And so they have a plan, which is let's say a long-term based objective for, let's say, a retirement RRSP, and then they have a plan for their trading accounts, which is going to be different. Think of it, the best analogy I could think of is, as an entrepreneur, are you limited to only owning one business? No, I know lots of entrepreneurs that own 2 or 3 or even 4 different businesses, right? And so what we have is a scenario where each of these you want to think of that the same way as you being an entrepreneur, which is the fact that you have the choice to, as an entrepreneur, in your trading, have a different plan for different accounts, right? And it's so important to be able to have that discipline to look at it that way. So let's look at the personal overview. This is important because this is very different for each person. So the thing is that we might have one person listening to this, and they're an 18-year-old or 19, 20-year-old just getting into out of post-secondary or into university, and they have a small amount of money, and they have a 40, 50-year time horizon for their investments. They have different goals than if you're listening to this and you're a 60-year-old investor and you are looking at saying, well, I want to retire soon and I want to live off this big nest egg I've accumulated. And so the goals are very different. So what you have to do is, first of all, reflect what is your account, what are your goals, what are you trying to achieve? The second is, how much time do you have to dedicate to it? A lot of individuals continue to work full time while investing, and so they may not be able to be watching the markets on an intraday basis. So if you're using technical analysis, and one of the things is that you have to be there the moment the stock starts moving so you can make an adjusting trade. Well, if you're working full time, that may be a big obstacle for you. At the same time, if you're already retired and you pretty much can keep an eye on the markets on a regular basis, then you can allocate more time. So you want to design a plan that fits your the constraints of you, right? The third point there is that we all face different mental and emotional obstacles. Some of us have experienced bad losses in the past, and the genuine fear that the money that you have invested could lose is a huge emotional trigger as well. You know, depending on where the money came from. Like, for instance, somebody that inherits a very large amount of money may have a more risk tolerance for volatility, while somebody who's literally saved every single dime that's in their trading account from being prudent and budgeting and saving, the idea that even being down 10% on that money may trigger a mental obstacle for you in terms of the fact that you feel like you need to do something and protect yourself. And so there's these different emotional obstacles we each have. You can't just write a plan that is a cookie cutter that fits everyone. You have to recognize that you are a very individual person, and the way you're going to approach investing and trading is going to be very different than the person next to you. And so you have to be able to make a plan that is personalized for the way you see the markets, the way you tolerate risk, the way you approach investing and trading. The fourth point is you have to assess what resources you need. Now, if you're actively trading, do I need a high-powered computer with 6 monitors and subscriptions to all these different services to have all sorts of live data? Or do I just need to have the right apps downloaded on my phone so on the go I can keep track of what my stocks are doing and how they're trading? And so what resources will you need? At the same time, each of us have a different attention span, a different focus, different things that are going on, as so many multitasking, so many things. How are you going to stay organized in your plan? For instance, if you have certain action points in your mandate as to when you're going to adjust a position or close a position or do something, how do you stay organized so that you know you're on top of all of the things that you need to do to keep your plan in play? And so these things are very personal. This is why we call it a personal assessment. You have to be able to think, and it's very much you, right? There's not it's not like you just copy and paste what I've written in for myself, right? And so that's the first component, as a first major component of that. The second component is the risk and money management. And the risk and money management are also very important because we need to be able to assess how much risk you're exposing yourself to and how you intend to manage it. So how do you size your investments or trades? Now, often, for instance, I'm a big advocate of using options, and so often I can size my risk by combining options with my stocks to define my maximum risk, and therefore I can change my position size to a certain size because I can know what my risk is. Other traders do things like they just go equal dollar sizes. They basically say, I'm going to own 20 different stocks that are a 5% allocation to each, while other people will adjust them for the volatility of the underlying security. There's different ways of approaching the sizing of your trades. There are famous ways of using, like for active traders, they're using things like the Kelly criterion or other things to help size their risk based upon their assessment of their trading methodology. But the point is that you should have some way of saying, how much do I put in any one investment, right? Then the second criteria is or component is, do you use stop losses? Now, it's not appropriate for everybody, but especially if you're a technical trader and you received a technical signal to buy, stop losses tend to be a mechanism from which technical traders say, well, the trade I thought was going to work isn't, and I need to get out. And the stop loss often is a trigger that moves the trader onto the sideline after a trade did not work. So even now, you could use stop losses, but there are other criteria you can use for exiting a trade, and you just need to have some methodology of doing that. Like, for instance, you could have believed that, let's say, Boeing was a great long-term fundamentally good investment, and then when they had the airplanes come crashing down and there's all sorts of problems, the fundamental situation in Boeing changed. Now, you didn't have to use a stop loss, but you do need to have some sort of criteria that basically says, well, maybe Boeing is not a good fit for my portfolio anymore. How are you going to decide how to exit a trade? If you don't know in advance what that criteria is, I will tell you right now, you're not going to exit when you should. If you don't know in advance, there are people today that when they bought Boeing at $400, still own it when it's at $150, and are probably going to hold it if it goes down to 80 because they did not have criteria for exiting the trade. Now, and criteria, by the way, doesn't have to be technical. The criteria can be fundamental based, right? Even though this was a technical series, it is important to point out that these rules are very much both applicable to fundamental approaches as well as technical. Now, as well, traders also utilize things like changing your position size. One way of exiting trades that is common amongst the more sophisticated traders is, rather than making it a binary all or nothing decision, I'm in or I'm out, what they may often choose to do is that when a trade isn't working, they reduce the position size. So let's say they had 1,000 shares of Royal Bank shares, and suddenly we're going into a recession and a big technical drop is occurring. Let's say, based upon some sort of criteria, that the trend is no longer in place. The trader says, I'm no longer going to own 1,000 shares. I'm going to sell 500 of them and reduce my position size to 500. Because at some juncture, I'm going to use that cash to get back in on a new signal of some sort. The point is that there are traders that, rather than making it this all or nothing decision, I'm in or out, they will use an adjustment of the position size based upon exiting criteria. At the same time, there are a lot of traders that like a company a lot, and the criteria for exiting did not exist, but yet the stock is cheaper than where you bought it. Do you have criteria for what that level would be where you would choose to dollar cost average, where you would buy more of the shares at a cheaper price and average your price better? Do you have that criteria? Often, again, when you shoot from the hip and you're making it up as you go, often it leads to mistakes. The best traders have this defined. They say, listen, if there's no fundamental reason to get out of the stock, but the stock has actually declined by X amount, I will use that as an opportunity to average my cost. And I will do so in this quantity or this ratio or something. They basically define the criteria for that. Now, the final point I want to make here is on the act of profit taking. Now, this is actually one of the hardest obstacles for retail investors to grasp. Because a lot of investors believe in the buy and hold approach, which is when they're making a very large amount of money on their stock, they perceive that those paper profits are real and that they just don't need to sell because it somehow magically will always stay at the higher price. But the most successful investors and traders that I have met have some form of a criteria for when is the right time to reduce the position and or close it outright, simply because it has met the profit objectives, right? And so, especially if you're a value investor or some other criteria, when a stock trades high enough, it's no longer value, right? And that's using a fundamental criteria, but there could be technical criteria, there could be all sorts. The point is, the best traders that I know not only know when to get into it or decide when to get into a trade and have criteria for it, but they also have criteria when they're going to take profits off the table. And it's so important to develop some form of a discipline or methodology to do so. So let's actually understand trading a little bit more by understanding randomness. And I want to talk about some statistics and just some ways of looking at this. So think of it no different than a coin toss. I'm using marbles because in my other programs I changed the quantity of white and black. But you could, for a 50-50 probability like I'm using here, it really can be viewed as a coin toss, head or tails. And so in this situation, let's just say, for the sake of this, that an investor puts in trades into the market, has $5,000 of risk capital, and chooses incredibly aggressively to size their max risk on each trade to 20% of that capital. So let's say it's a $5,000 allocation. They're risking $1,000 or 20% of that of risk of loss on any one trade. Now, there's some form of leverage often, or maybe a speculative stock. It's not the important part. What we're trying to demonstrate is how random a sequence of outcomes can actually occur. And so what I want to show you here is I want to ask you a simple question. If we drew 100 of these marbles that we talked about over here, always returning a marble to never change the 50-50 probability, what is the probability at any one time of the trader being drawn down to zero after a sequence of the black marbles of losing trades? So remember, if we draw a black marble, it's a losing trade. We lose $1,000. And if we draw a white marble, it's a winning trade, and we make $1,000. And so you're playing just simply a 50-50 probability. What I'm trying to capture here is understanding the probabilities of a sequential series of losing trades that create what we call in the trading world as a drawdown. And so what I have here is just a matrix that looks at this and says, if we had no better than a 50-50 success rate in our trading, notice here that what is the probability out of 100 draws that there could be 5 sequential, so we're going to go to the 5 column here, of that you could have 5 sequential losing trades in a row. So that means draw a black marble, draw a black marble, draw another black marble, draw another black marble, and draw another black marble. Now, if you look back at that, when we were allocating 20% of the capital to each trade, and that always resizing it to 20% capital, understand there's an 81% probability that after 100 draws that there will have been a 5 black ball draw sequence. What that basically means is somebody sized their risk that big and had that kind of probabilities, there's a very good odds that they would blow up the trading account. I mean, obviously, we're looking at it as a marbles game, which is more equivalent to gambling at a casino. But it does give you an idea of what is involved. Risk management, trading sizing your trades correctly, doing all of these things is so important. And so along the way. So this is where I wanted to touch on this chart. What a lot of people believe is that if they're successfully investing in trading, that it should look like a straight line up, which is I invest $100,000 and it grows to $200,000 after 5, 6, 7 years. If I did it right, then I should see this nice sequence. But in reality, as you're putting investments in and out of your account and losses occur and gains occur, what we experience is a lot of volatility. And that volatility that's swinging higher and lower is where discipline and consistency is so important, because the most common characteristic of new traders or retail traders is they do something consistently until they experience a little bit of pain and they abandon whatever they were doing to try something new because they experienced one little drawdown. And so what you want to think is that if you don't have a good plan that you genuinely believe in, then the moment you go through any drawdown sequence, you're going to change the style of your investing and trading because you just don't have the emotional fortitude to stay with it, right? And so that's just my little thing on that. So I want to move on to the execution strategy. And so with the execution strategy, what is your criteria for getting in or out, right? So you might have macro or fundamental criteria for an investment. Like there has to be some reason for it. There's nothing wrong with using macro and fundamental criteria. But often complementary to that, people associate a technical criteria for the actual act of making the decision to buy or sell. And we covered some of those criteria in the prior 4 module or parts of the series, where we talked about some, different techniques, moving averages, or different types of analysis that you could use for criteria for buying or selling. Now, defining the criteria is also about not only entering but exiting the trades. When do you lock in profits? When do you outright sell? When do you rebalance your weighting? Often you applying these rules to portfolio rebalancing, the criteria might be that if, let's say, you had a 60-40 mix, 60% equity, 40% bonds, and bonds are underperforming and equities are outperforming, and now you find that you have 35% in bonds and 65% in equity, you might have a criteria that based on as soon as you have a 5% divergence from that weighting, then you're going to rebalance, sell 5% of the equity and reinvest it in bonds and rebalance back to a 60-40 weighting, right? And so you could have a fundamental or portfolio management criteria for this. At the same time, if you have very specific investment themes within your portfolio, what is the criteria for cutting the loss, outright selling, or simply reducing that position? Everyone should have a plan. And to be honest, I want to just reiterate the same point. This doesn't have to be complex. Just have to have some very basic rules that you actually know that you're capable of following. It's not about rocket science. It's not about reinventing the wheel. It's just define yourself as an investor. And this could be a longer term picture. It doesn't have to be short term day trading or anything crazy. Just what is the mechanism from which you define all of that? What is the criteria for what a stock will have to have moved for you to dollar cost to average it? All of these things should be defined in the execution strategy within your plan. And so the last thing I want to leave you with is the results review. And a proper method has the ability for you to measure your results. Now, measuring your results doesn't necessarily have to be whether you're making money, because during a bear market, it's sometimes hard for someone who's not willing to short sell to actually be making money. But the thing is that part of the results review is actually, are you executing the strategy based upon the mandate you gave yourself? Right? Have you followed the rules? Are you actually, even though you might be in a drawdown, are you actually following a plan that over the long term will be successful? And you just need to continue to execute your plan continuously within that mandate, right? And so what this is about, maintaining investing and trading history, it's not just about printing out your transaction history. Often you forget why you bought or sold something in the past. Keeping an actual trade log, something with notes, something that says, this investment was bought because of this criteria. These were the rules I set out for it. You should have some way of being able to go back and re-review each of your trades. You want to focus on assessing a larger trading strategy versus individual trades. The biggest mistake is that, going back a few slides, when you go through one of these zigzags, you go through a drawdown on the downside and you go through one of these zigzags downwards, you always will come to a point where if you're focusing on just this short-term individual trades, then you're going to be assessing just the last few losers. What you want to step back and reflect, have I been executing all of my trades over, let's say, the last year in accordance with the criteria I've set out? You don't want to overthink short-term losing streaks with the bigger plan. And so it's so important to be able to do that. And one of the best things to do is set yourself out a quarterly, semi-annual, or annual period where you go and assess it. I want to show a great extreme. And it's extreme, but the great Jesse Livermore, one of the great famous traders from the 1920s and 30s, he every year would liquidate all of his portfolios to cash at the end of the year. And now this is funny how this plays out, but he used to get his bank manager over the New Year holiday to lock him in the bank vault, sitting on all of his money. And he would go through every transaction he did that year, and while everyone's partying for New Year's, he would sit there and assess every decision he made all year long. And he sat on his money in the bank vault because he never wanted to forget that the money was real. And it's like a most bizarre, and that's quite eccentric, and I would never recommend you doing it. I don't even think you can get your bank to do that for you. But it is just an example of why it's so important to set out a criteria for results review. Just understanding when am I gonna assess it, how am I gonna look at it. So recognizing most professionals and that are successful have a process, a methodology. It doesn't have to be complex. Again, I'll repeat, it just has to be straightforward and simple. But you need to be able to execute it with consistency and discipline. You have to be able to track it, and you have to be able to analyze whether or not it is actually being executed well. And so that's really the criteria that you want to always be looking at throughout this period. Anyway, that was what I wanted to leave all of you with, because when we're using technical analysis in the trading process, what you want to remember is that you're doing a lot of buying and selling, and you want to have a solid foundation of criteria as to what I'm using, why I'm using it. We've covered so much technical analysis. You don't need to use it all. Sometimes it's as simple as a moving average crossover. You say, look, I'm only going to be fully invested in a stock when the moving average crossovers are bullishly turned. And when it's negative, I only ever hold half of the shares. So let's say you own your favorite stock. You own 1,000 shares when it's bullishly, the crossovers are bullishly pointed, and you only ever own 500 shares when they're negative. What you're doing is trying to not always go in and out of a position in its entirety, but rather to tactically trade around a core position that is yours. That's just an example of different ways of approaching it. and that is going to be completely stylized to you. You're going to have something very unique in the way that you're looking at this market that is very different than what everyone else does. And it's just find out what's right for you. Anyway, I'm Patrick from Big Picture Trading. You could listen to our Macro Voices and Market Huddle podcasts. You can follow me on Twitter at Patrick Ceresna, and find me at Big Picture Trading, where we do this full time. So if you want to learn more, come and check me out. Anyway, thank you for joining me, and we'll get to some Q&A.
Thank you so much, Patrick, and thank you all for joining us. For those of you who want to revisit parts 1 through 4, just click on the resources to your right. And for those of you in the live session, we now go on to questions.